I just want to check that I am audible and visible. Cool. Once again, I just like to say that I would prefer it if POS were offered via chat. All right then. Starting my speech in 3, 2, 1. How is this policy going to be done? What do we support essentially? We support for like banks and like countries that have the capability of being able to digitize their currency in like the CBDC format to be able to do so, i.e., switch their currency and to like the more blockchain format, etc. We think largely this is going to be phased in, and it's mainly going to be done by developed countries that have the infrastructure to do so. But we will also be working with like implementing this in the developing world as we move forward. This is because companies have the incentive to digitize the developing world to be able to better access them. But also, secondly, countries are going to want to continue to trade with the developing world. It's easier to do trade via the CBDC will prove that, and therefore they have an incentive to invest and ensure that the developing world improves in that regard as well. Second piece of framing that I want to give is just what is the difference between a normal fiat currency that is digitized and the CBDC. Normal fiat currency is primarily like a physical transaction of currency. So even if you're doing digital transactions online, you are still going to have to physically move cash from bank to a different bank, from one account to another account at some point in time. Usually banks ignore this because they believe that the cycle of money means that the money doesn't shift too much. But we think that like once you get larger transactions or as transactions happen over time, you do need to move physical assets. And this is baked within the physical like cash assets that banks have like internally. But secondly, we think the difference is that CBDC is fully tokenized, i.e. it is on a blockchain. You no longer need to hold physical cash assets within banks or other places. The value of that comes from a central source, which is the central bank that tokenizes these by like, like pegging its value to things like baskets of cash or gold that they hold internally. These transactions happen on the blockchain, so you are no longer reliant on banks. Before I move on, clarification,
So as far as I understand, these kinds of fiat currency digital on the blockchain are still not decentralized like cryptocurrency, but all the transactions are run through the central bank. Is that what you stand by?
The transactions are run on the blockchain, so it will be decentralized, but the actual like value that you retain from these currency come from the basket of goods or gold or like the varying currencies that you may hold in central banks, as most currency value comes from. So the difference, this is from like a different cryptocurrency, like a cryptocurrency and a CBDC, is that CBDC still has some physical assets that are held in a central bank, but the transactions are done on the blockchain. I hope that was clear. Okay, 2 arguments then in my speech. Firstly, why it is easier for governments to control fiscal policy and the impacts of that, and secondly, on how switching and doing the switch right now improves digital currencies in the future. Firstly, on why it is easier for governments to control fiscal policy and the impacts of this. One, we think it is easier for you to control your fiscal policy at the point at which you have CBDCs. What does controlling your fiscal policy look like? It looks like from the top, doing things like changing and setting interest rates within banks. While this may be easy to talk to individual banks, we think that this takes a lot of time and has a lot of bureaucratic issues in being able to turn to each and every individual bank, ensure that they're regulating this properly, ensure they're setting the interest rates well. But it also just looks like it is harder for you to control fiscal policy and have a direct impact if it's only via banks, because not every individual engages in the banking system or has ability to access the banking system. We think the comparative is more people have ability to access digitalized like set systems. This is just because in today's world, we're seeing a lot of investment that is being done in digitizing and ensuring the spread of the internet. More than it was like 75% of developing countries like India have access to the internet compared to just the very minute like places that have access to banks. This is because the barrier for you to be able to invest in infrastructure for banking is so much higher than it is to invest in infrastructure for the internet. This is because you need to be able to have physical buildings that have like a good enough security system, that have employees that are able to do things like ensure that bank works properly. So it is harder for you to spread that banking everywhere. So there are fewer people who have access to banking than it is to digital systems. But secondly, we just think that when you are doing things like relying on bank and interest rates to control your fiscal policy, you need to predict how people are going to respond. Is this increase in interest rate enough to ensure that people are going to now put more money in their banks and spend less? Is the decrease in investment in interest rate enough for people to pull their money out of these banks and spend more? We think that the difference is if you can directly do things like change the value of that currency by being able to artificially increase the number of the bills that are circulating, or artificially decrease the number of bills that are circulating as a central bank, by being able to do things like faster sell and buy bonds back. That is the point at which we think you are better able to directly influence the way people are spending. But also you can directly influence the taxes. So what this means is that if you can directly increase the taxes or like lower the taxes, like that, you can better influence the way people are holding or like not holding the cash that they have. The impact of this is you have better and faster crisis response. Why is this important? Because we think every day that you wait to respond to crisis could be days of your currency completely losing its value. Every time a bank fails because of its risky decisions that it does internally is a day where people lose their life savings. We think at the point at which we allow people to continue to put food on the table or at least be able to regain the ability to do so, we win this round. I want to nuance banks really quickly before I move forward. I just think that you're still going to have things like loans on our side of the house because people are still going to invest in things like mutual funds. In fact, we think it's easier for them to do so when they can access this digitally instead of having to do things like create or go to banks and set up accounts there. So it's easier for you to do things like have Robinhood and then create the loans from that. But also you're less likely to have things like bank runs at the point at which it's easier for banks to digitally take in more cash from another avenue when people come and demand the physical cash, when people can't come and demand physical cash at their location. Bank runs happen because once people go there and it is too slow for banks to be able to come and take a new cash or give out new cash, people lose their faith and that causes the economy to crash overall. Before I move on, CEO.
There's no delta on your side because the current bank does that already. How are you going to rely on a system that is going to revolutionize the way we see money? How are people going to react to that?
We think people are already getting more and more used to the front end of like interacting with digital currencies when they interact with digital fiat currency already. They don't really like care or look deeply into like what happens behind the scenes, whether it's blockchain or held by banks. Most people don't really understand how digital currency works already. We think as long as you're able to like still barter and like sell goods and buy goods, it doesn't really impact people. Argument two, why switching now makes things better. I just want to note that if you were to switch as a developed world, especially, you increase the investment that is done on researching and improving the way CBDCs operate because you increase the demand for this, which means that more companies and more like researchers have the incentive to like work forward and ensure that this improves. But also, as you face this in, you're able to point out early flaws. It's not just like some random crypto bros talking, but like a general society and more important people doing this. What that essentially means is we can improve the system. This has two impacts. One, for the developing world, this is crucial because you can avoid things like banking fees and ensure that you get like better return on the like the remittances that people send back. When we know large countries are dependent on remittances, countries like Nigeria, India, and Philippines, if you're able to remove the large amount of cash that is lost in banking fees, that is each individual dollar that could be life-changing for the lives of these people back home. But also, secondly, we improve the security because like you can't like physically break in or and lose out these cash, etc. I'm so proud to propose.
I'd like to thank the Prime Minister for that speech, and I call on the Leader of the Opposition. Hear, hear.
Cool. Can you hear me?
Yes, you're audible.
Thank you so much. Opening government just stood up here and told you a bunch of lies about how CBDCs work, about the fact that they're decentralized, which notably they are not. They say that you can store these in banks. Notably, you can't. The info side itself says that these are stored on the blockchain. And I think that takes out a lot of opening government's benefits, largely because they do not understand what this currency even is. Three things in this speech. Firstly, on setup. Secondly, on how this removes intermediaries like banks and why that's particularly harmful. And thirdly, on privacy concerns. Firstly, on setup. The first thing to note in setup is that CBDCs have been set up and researched in the developed world as a counter to cryptocurrencies, but that is because the core issue that governments are concerned about is that there is a loss of control in the amount of money that people spend and put into the economy because it has become decentralized and put in the hands of individuals instead of the hands of central banks. And obviously cryptocurrencies come with a lot of concerns about volatility of the economy that these governments do not want to run into by making these currencies decentralized. That's why these central bank controlled cryptocurrencies or direct currencies or whatever they're called have taken steps to not be decentralized because the government wants that control, and that's why it's stored on the blockchain rather than stored in banks. And the governments want to counter that crypto. If they want to stand behind decentralized currencies, they have to stand behind the amount of volatility those create when users can mine for their own types of currency, and that currency spirals out of the hands of central banks. When the value of that currency changes compared to the US dollar day to day, I think that's particularly harmful, particularly volatile, and not something worth introducing at all. So if they stand by that, I think opening government's already steps behind the opposition bench. The next thing to note and set up, as pointed out in the closing opposition POI, is that a lot of opening government is symmetric, which is that central banks already do a lot of the things that they talk about. Central banks already control how much interest rates they charge their banks to take their currencies, for example. It's unclear how much doing that faster is particularly a harm, or why this is particularly slow at the moment. I don't think opening government is able to prove a lot of stuff there. The last thing to say here is they have some miscellaneous stuff about tax and how central banks can do that, but central banks don't even handle anything to do with tax. That's all done by like revenue departments organized by the government, not the central bank, because tax revenue doesn't go to the bank. It goes to the government. Okay, then let's talk about why this removes intermediaries then, and why that's particularly harmful. The first thing I want to note at the start of this point is to deal with the developing world context about how this will lower bank fees for them. I would say that this is a non-existent problem in the status quo due to the fact that many companies have been set up in a way to try avoid the huge amount of fees you have to pay when you like send remittances from the United States to the Philippines, for example. That's why companies like Wise, companies like Alipay have very low transaction fees and are quite decentralized, like outside of one country, and operate in many countries. So it's very easy to send, currency between those countries. I don't think that's a particularly large issue. Next then, let's explain why many people are likely to remove their money from banks and operate on the blockchain instead. Firstly, we think that companies feel like they have more control over their currency when they can buy a spot on the blockchain that is worth a specific amount of money, rather than putting their money into a bank where, the bank has control over how much you can take out at a certain time, and you don't have access to all of that money at once, because you can't take it all out at once without the risk of bankrupting the bank. Secondly, we think wealthy people also have similar incentives to want to be able to control the amount of currency they have, and are similarly likely to be able to want to take a section on the blockchain to own for themselves. And this is because they want, the control. They don't want to have to pay the bank fees that you don't have to pay on a central bank. They don't want to have to pay the interest rates that you have to pay to a central bank. But also, this currency also works like an asset. So at the point where this currency becomes more valuable and more people want a spot on that blockchain, this currency is likely to appreciate. And that appreciates at a far higher rate than the bank, because this is viewed as prestigious, it's viewed as new, it's viewed as something that lots of people want to get hands on in. So many people want to invest in this early because they think that their asset is likely to go up. And I think that means that they would rather buy spots on the blockchain rather than have their money in a traditional bank. Next thing, we're going to explain who the type of people who cannot access buying a spot on the blockchain is, who can't access CBDCs and have to rely on banks. Firstly, people who lack access to capital-intensive technology, because to buy a spot on the blockchain, you do need quite high-powered computers. You need quite, heavy industrial connections. You need a very strong internet connection that has a lot of bits per minute, so that you're able to access a high-speed internet connection. I think that means that all the stuff that opening government talks about the developing world is largely out, because people who don't have access to banks right now still don't have the technology to be able to access a spot on the blockchain because of the capital intensive nature. Secondly, it's quite a knowledge intensive nature as well, which you need a lot of financial knowledge to be able to know, how to invest in this type of industry. You need a lot of computer science knowledge to be able to know how to access that area of the internet and how to work the blockchain. I think that's a knowledge a lot of people in society lack. But thirdly, many people trust the bank teller and, want to just be able to have a face-to-face connection. That's why many older people, for example, have regretted the rise of technology. Before I move on to the impact of this, I'll take closing government. Opening government.
So to be clear, your alternative transaction system is to rely on banks.
Yeah, we're fine with the status quo. All right, let's talk about the impact of banks then. We think that when less people utilize the services of bank, that harms all the people who particularly still need banks, which I would know are the most vulnerable individuals in this debate that you should care about. Because now there's less money for the bank to invest in, which means each individual person in that bank gets less returns and less, investment on their appreciations. Bank makes less profit, which means they probably charge you higher fees to make up for the fact that people have taken money out of their bank. And there's less lending being able to be done to companies overall because they have less pool of money in the bank overall. But secondly, we think bank runs are far more likely because people move their money from the bank to buying a spot on that blockchain, which lowers the levels of reserve cash that those banks have. Lastly, then, let's talk about privacy. We think that a traditional block, we think that to maintain control, these currencies have to go, these transactions have to go through the central bank compared to a normal currency where you just issue it to someone and then you let the notes float around and do whatever. We think this is a huge vulnerability in the system because now you just have to attack one central system where every blockchain transaction goes through to be able to access a wealth of people's private information. We think this is particularly vulnerable to hacking. But secondly, we think it's bad that the government just has access to all the financial records of what people are doing with their money. Huge developed countries like China will have access to all of your financial information, all of the things you buy. We don't think government should have access to that kind of information, and we don't think hackers should be able to get it either.
I'd like to thank the Leader of the Opposition for that speech, and I now call on the Deputy Prime Minister here.
Okay. Can I be heard and seen clearly?
Yes, you're audible and visible.
Perfect. Okay, let's start my speech in 3, 2, 1. There are going to be two large parts to my case. Firstly, it's just talking about the exclusive benefits of swapping to using CBDCs, refuting majority of the rebuttals basically integrating this part. Second, directly rebutting to opening opposition's case. Why is it not important that individuals prefer to more control in their security concerns? Firstly, but before all of this, let's talk about how this specifically works. I think that opening opposition is confused about what they've said. We agree that CBDC is likely going to be run by the central bank and probably monitored and regulated by a central bank, but it's likely to be built on blockchain technology. That is to say, the distribution of the type of currency is likely to be decentralized and therefore significantly faster, but there's a better way to actively track down these things because blockchain basically means that individual things are tokenized so that you get an individual identification number with a lot of the unit of currency. But obviously the ledger for how blockchain works, by the way, the server for where it's run is probably going to be run and managed by the central bank. So this means that it's not going to be completely decentralized in the way that OO means by what they mean by decentralized. It is likely to be regulated and run by central bank. This means that we're willing to bite the harm and say you increase government control. So why is it significantly better that you're able to increase government control then? There are multiple reasons why CBDC is a better form of digital currency, namely 5. Firstly, it is a more efficient type of currency. That is to say, a CBDC distributed through blockchain technology is often significantly cheaper, faster, and way more accessible than the current financial system because you don't have to use as much technology in between to make sure you're able to track everything correctly, to make sure that things don't go wrong. And specifically, we think that anyone with a mobile device can often utilize CBDC, and digital currencies are going to be distributed in a way that's significantly better. This is super important because you save huge amount of money that people actually care about in between when making these transactions. So yeah, maybe you only save $1, and to a lot of us who are privileged, that doesn't really matter, but that's actually 100 rupees that people can use on their food, that people can use on spending other things that's not spent on stupid financial inefficiencies. Second, literally, this is probably likely to be more accessible. OO explicitly lied and said that, oh, you need high computational power computer to literally own CBDC. What do you think this is? This is not an art piece blockchain thing, an NFT that you're trying to buy an investment. This is just literally how you store your money. Instead of storing it in physical cash or other types of digital currency that's not as good, you're literally just storing it as CBDC. A lot of these servers that require high computation power will be ran and supported or funded by the government, by the central bank anyway. So the cost doesn't actually fall on you. The cost just falls on the government. This means that it removes, but I think importantly, it is probably way more accessible because a CBDC actually doesn't require citizens citizens to hold a bank account. I think banks often require minimum amounts or like charge fees for certain actions. Some banks even like require you to have block money movements for some customers. On our side of the house, CBDC is simply managed through a digital service. You don't need to do that because it's now not done through commercial bank, but directly to the central bank. This means that significantly there are more rural and underdeveloped areas in developed countries that are able to gain better access. So in the status quo, there's an estimated about, I don't know, like probably like 5% of US households that are currently unbanked or underbanked in 2021. This means that a lot of people in a lot of households can't actually have a checking and saving account in traditional bank. This solves that problem, and even in a developed country, this probably is a huge amount of population that actually significantly gets improved. Like, I don't know, 5% of the US is probably like I don't know, 5 million or like 6 million people. And that's probably a significant amount of people that are in underdeveloped areas that are able to access financial services. We're so proud that they're able to do so. So that's probably a good thing. Thirdly, CBDC removes the need for banks and similar fund management to actually approve transactions and having people on the ground to check how much money they can move, et cetera, et cetera. This means it's significantly easier for us to do things like track tax evasion and wage delaying. This is because the central bank, even though OO claims that does not deal with tax, the fact that a currency is stored in a way that makes it easier for people to trust whether you're not like, you know, tax evading or whether you're like sending money or like delaying your wages, means that there's significantly more control over whether these things can be allowed. We think that greater regulation requires greater technology that have more precise tracking of where these things go and whatnot. I think that we get better on our side of the house. Lastly, I just think that like the alternative of just like decentralized blockchain or traditional currency is just not as safe, because the network basically means that because blockchain technology being like when the ledger is operated by central bank means that you have higher accuracy and higher trust. I think you have better oversight that actually help banks fight illegal activity like things like money laundering or suspicious transactions, because you're literally able to track down value by value using blockchain technology. Before I talk about why dealing with crisis quicker is also a really good thing and that government having control over this makes it more precise, responding to thing of like I'm not sure why faster policy matters, I'll take a point from closing opposition if I have one.
Yeah, so if everyone has a phone, then why don't you just do regular online banking that exists with physical currency? You didn't prove why people are able to access this given the technology.
Obviously, because there are other costs associated with having a traditional bank account, right? As I told you, it's because sometimes you need a minimal amount. It's because sometimes in order to interact with those currencies, you have to go to a physical place. But that even with a phone, you probably have to sign up for a bunch of different things. On our side of the house, when that currency is literally managed by central bank and that your money is just directly transitioned between central bank, and even if it's done through a commercial bank, right? When that currency is just done through a blockchain technology, it's likely to be distributed in a cheaper way. Like all of these things still matter. Also, that's like literally one thing out of 4 things I've said. So like, you know, also try to deal with other things. Fifthly, why is it good that you're able to deal with crisis faster on our side? I think there are a few things to be said here. Number one, monetary policies and like the way that central bank like do things like interest rate often have a problem of time lag. That is to say, even when they say, I'm going to change the conversion ratio of like the central bank, and so you can't really borrow that much money, or the amount of money that bank can like now send out is less, there's often a delay because of your ability to track down physical currency and your ability to directly like limit the flow of that currency. On our side of the house, it's really quick for you to do that because it's completely digitalized and blockchain, so it's safe to do that as well. And so a lot of like people who have trust in that could be done. These precise tools mean that you can implement monetary policy that's often going to be significantly more accurate. So you can probably target certain regions better on our side, because like on their side of the house, you kind of have to do it like all blanketed in one region. On our side, it's very easy for you to digitally just adjust for one region. But secondly, you can probably do it way quicker because it's a matter of like multiple clicks on your computer in comparison to like actually having to send people around and like having to like change the ratio of different banks. On our side of the house, we think that dealing with crisis earlier is also really, really important, because this is literally a matter of whether we're going to go into an economic downturn and having more shops closed down, more things on the street closed down in comparison to a quicker dealt with this crisis. Lastly, they say like, companies prefer or individuals prefer to have more control. I just want them to weigh all of these things against all of the things I've talked about, because presumably a few individuals might be pissed off and invest in blockchain instead, or they might be like, oh my god, my privacy is now invaded. We don't care, because all of the benefits I've talked about actually means that a bunch of people benefit on the ground. People get better access to financial services. People in rural areas are now actually able to trust a bank and store money in a more effective way. We also think that this actually helps develop countries, like set an example for the developing countries, which is good because it makes the technology better in the long run. All those reasons, proud to propose.
I'd like to thank the Deputy Prime Minister for that speech and now call on the Deputy Leader of the Opposition. Here.
Hi, am I audible?
Yes, you're audible.
Oh, I'll take POIs in the chat. All right. I think the government bench in this debate, because of the motion, is in a very interesting place where they have to kind of define this unhappy medium between normal fiat currency that, yes, can be digitalized and be easy to track in the exact same manner that they talk about, but also not full cryptocurrency that's decentralized. And this really awkward position they're in means that they're able maybe to marginally increase efficiency in certain areas, but at the cost of being super vulnerable to external attacks and to internal corruption, but also vulnerable to just not being able to provide for the most vulnerable people that they talk about. I'm going to start off by explaining what is different between the worlds, and then go through the benefits that we hear from opening opposition, from opening government, I mean, and flip all of those to show how our harms that we brought to you at LO to very minimal response beyond a characterization response still stands in this debate. So what is the difference in the world today? Between the sides. The first one I think that isn't contested by either side is that now fiat currency is stored on the blockchain and not in banks. So that means that the store of value of your currency of the country is no longer in banks and is, even if they're phasing this out, slowly moves away from those banks, which means that the most vulnerable individuals that can't access that extra level of additional mechanization of cryptocurrency, I'll explain that a little bit more later on, is left behind in a worse situation, but also kind of harms the response to crisis analysis, because if that store of value is in the blockchain, yes, they can maybe change the value of the blockchain in terms of interest rates, and we're not really sure how they can do that, but then they lose the lever of central bank interest rates that then impact how banks themselves can have multiple different interest rates to react to that. So the flexibility that happens after the central bank sets the general direction of the economy is completely lost on their side, and therefore the central bank is much less able to actually make change. It doesn't have unconsidered impacts because they're setting a blanket policy on the blockchain that impacts the vast majority of the market, as opposed to the trickle down that is far easier to fit to different circumstances and different regions. But the second difference is that it's not decentralized. I'm going to explain this through the what blockchain is and why they on their side can't access the benefits of both worlds as they claim to do so. So the important thing to note here is obviously, you have to have some level of centralization. Otherwise, it's just cryptocurrency and it's not the motion that they're talking about. But let's explain specifically why it can't be that. Because the benefit of complete cryptocurrency in a complete blockchain that's decentralized is that you get validation that happens internally, right? So users are validating each other's transactions. And the validation of transactions is important to ensure that you aren't doubling down or you aren't having the same money being paid to different people, and ensuring that that transaction then gets locked into the blockchain in a bunch of transactions that are then, cryptographically encoded, and that's the encoding and decoding that is relatively costly, right? So it's relatively costly in computing power in terms of the amount of energy it takes, all that thing. To make that worthwhile on a cryptocurrency blockchain, that's why you reward users themselves doing that validation, proof of stake or whatever, with new crypto, like a token of a new crypto. So they get paid for doing that. And that happens on the general cryptocurrency blockchain. Now, obviously, you can't do that because in order to maintain control over your own currency and not have it just fluctuate and be volatile like a cryptocurrency, you can't let that validation happen internally within the blockchain. So that validation, that very costly validation, still happens in the central bank as per kind of the turnaround that we hear at DPM. That means that the central bank now has to validate all those transactions. So the cost of validating transactions is not free. It's still held by the central bank. So there's still going to be fees in order for the central bank to actually not make a loss on doing that for free. So therefore, the cost still exists. It's unclear as to why that cost is so much lower than the cost that digitized banks could do, or the competitive pressures of having Alipay and Wise would reduce all those transactions down as is happening in the status quo. So very unclear what that benefit would be from opening government. But the second thing to note there is that validation itself requires proof of identity. It requires the central bank to be able to validate that transaction between two individuals, which means all the normal requirements that banks have in order for you to be validated in the system. Having a bank account means having those kinds of identification documents, all those things. The types of people that can't access bank accounts because of all those barriers, remember the cost barriers are reducing due to competition, that means that the same kind of barriers exist for the groups on their side. I hope that clarifies what the difference in this debate is and locks out a lot of the, I guess, rather extreme claims of benefits that we hear from opening government please realize that it's not as big as that and more reasonable. Let's talk about controlling fiat currency, but actually before that, let's talk about access to banks, right? So note that it's not crypto, it's supposed to be validated through a central bank. The limiting factors I've already explained is the thing that people don't have, poor individuals, like they don't have a proper address to be able to get that identification. So they aren't able to get those things in status quo anyway. But now there's an additional burden of being able to access that technology, which is not really available to most people. If it was, as we hear from a POI, but also at LO, you can just digitize the banks to give them the access to that technology, right? Which means that the people who are left behind are the people that don't have the tech savviness or the financial knowledge to even consider this, because it's relatively scary. It's different from how they don't know how to use it. They can't kind of physically see that they can go to the bank and talk to a bank teller. So therefore, those most financially vulnerable individuals are left behind with much harder interest rates to access because there's much less money in the bank, but also higher fees. Note that this also increases the risk of bank runs on their side of the house, because even if you're phasing and setting it up, the initial blockchain, if the tech-savvy people and the people who can make the most amount of money by shifting a lot of their private capital away from the banking system onto the blockchain system, starts taking money out to try and be the first ones on the blockchain, even if it's phasing a little bit, that's a huge amount of money that probably doesn't match the reserves of the bank and are likely to create that crisis in the first place when people try and move there. I'll take a point from closing government before I move on.
So, as mentioned before, the process of switching to CBDCs it will take a long time. So I don't think you can claim that so many people will be drastically affected in the short term just because there is information asymmetry.
Yeah, but I think it can happen that the long-term harm of people getting left behind happens in the long and medium term. The short-term harms can happen in some contexts, and it's a relatively huge risk of having bank runs in your country and reducing the confidence of investors, reducing the confidence of the international market in general. Generally a bad look that we think is not worth the risk of tiny bits of efficiency increases. Let's talk about those government levels, right? Changing interest rates. You don't talk to the banks, you just do that. And then these banks care about what the central bank interest rates is, so preemptively also keep an eye out, and once it happens, changes very quickly. So it's unclear why that being fast is really important. You still have to predict how people respond. It's not like the information you get in the blockchain is put into an AI that starts predicting it. That's ridiculous. So the time delay is not actually that useful. I think my introduction already responds to that. Privacy isn't the main harm from having that one bit of vulnerability of the central bank having to go through all transactions, but it's a huge one, right? We should not have people having all of their private details being accessible to any actor that attacks it. But also, that is the vulnerability. If a cyber attack happens to the bank account, the central bank's transaction account, that it halts the entire economy. That vulnerability is not worth the tiny bits of efficiency you get from the government.
I'd like to thank the Deputy Leader of the Opposition for that speech, and I'd like to call on the government member. Here.
I love your camera. This thing, click on that. Yeah, click on the camera. Yeah. Hello, can I be seen and heard?
Yes, you're visible and audible.
Okay. Two notes of housekeeping that need to be addressed. First of all, I want to explain in the debate that the digitization of transactions is inevitable. First of all, opening opposition concedes this and explains that private intermediaries will take over and create digital wallets, which will be run by banks and even financial institutions that aren't banks, like Wise or Gcash, for instance, in the Philippines. Second of all, there's also the rise of cryptocurrency as people distrust traditional financial institutions. So I want to note this debate is a specific question of which actor will lead the digitization. Is it state that will recognize and officiate this as legal tender and as currency? Or will it be done in the hands of private actors instead? That is the extension that we'll talk about later. The second thing that I want to note is there's an incredibly large deadlock in terms of the facts in the debate, in terms of the extent of control governments can have in terms of the blockchain. We will agree with the constraints that are put forward from opening opposition. Maybe you cannot control the volume of currency and intervene as much in terms of setting interest rates as a result. We will take the higher burden that opening government does, such that even if you cannot intervene in terms of trying to flood more money into the economy, one, we will spin it and say that's a good thing, and we will just say that you will just place value on the currency and that's it. So each extension that I will have in my speech will directly rebut all the ideas that coming from opening opposition. So I will start now. The first extension that I want to launch is you're able to escape private financial institutions from being predatory. And I want to uniquely position this argument against what opening government launches. Opening government explains that financial institutions are harmful insofar as you cannot access them because there's a minimum threshold for you being able to access a bank and geographical constraints. Our harm will be that they are predatory and in fact will dry you of capital, will make you poorer, increase inequality, which is an even larger impact that opening government simply doesn't talk about. Because even if you can access it versus what opening government talks about, when you access it, it will be bad. 3 reasons why. Number one, the market for digital currencies will likely be an oligopoly or monopoly for 2 reasons. One, it's simply more convenient for all users and citizens to use one transaction system and a digital wallet. So it doesn't make sense for you to have, 10 different banks and 10 different digital wallets. You'll likely only have 2 or 3. Second of all, it also consequently made by banks. The market for banks is an oligopoly because there are high fixed costs and barriers of entry to be able to create a financial institution in the first place. The reason why this is harmful is that this directly clashes with the incentive that opening opposition gives about setting low fees. That is not true. What happens is that a lot of banks can take abuse of the inelasticity of these financial institutions and can set high middleman fees, can set high intermediary fees, do things such that you have to pay an extra $1 or 50 cents for every transaction that you do that's over like $50 or whatever. And this happens all the time with a lot of wire transfers, for instance, or even in the Philippines where you have GCash and doing things like forcing transaction fees everywhere. The second harm of this is that even if there's a profit incentive to capture the entire market as much as possible, the main problem is that the comparative on our side, where you have the government that is the one managing the digital wallet, they have no profit incentive, right? This is the government. They don't care about making a profit, given that it's not in their motive base in the first place, which means that they're just not going to set any transaction fee. So the comparative to our side is even if the transaction fee is low, ours is none, which is why it's better on our side. But the third reason why it's better is we think that there's also a perverse profit incentive for a lot of these financial institutions to be predatory and force them into specific financial products through false advertising. This is what, for instance, happened with a lot of digital wallets, where they try to entice you through their user interface system to get you to purchasing, for instance, a specific loan or line of credit that may not actually be appropriate for your financial circumstances at that moment. What we do under our side is there's greater accountability mechanism to make the user interface and the digital wallet more transparent when it's in the blockchain, and so that there is no prescriptive analysis for what the consumer should do, and there's simply more freedom. So this extension is independently debate winning because it flips all the arguments that opening opposition wants to talk about. If it's true that they will exist, private intermediaries will be there, they will set high transaction fees. They will make them poor. That is bad. Before I move on,
Digital fiat currency has meant that everyone has access to digital transactions. Given that CBDCs are still state controlled, why would people who use crypto, who don't trust the government, utilize CBDCs?
So there are, okay, actually, that's perfect. Let's move on to the second extension, why you combat the dangers of cryptocurrency. So I just want to explain that the first extension talks about banks. This one is about crypto. So O problematizes that CBDCs exist to combat cryptocurrencies and it will fail at doing so. The problem is that they don't conversely explain why you're able to escape the harms of cryptocurrencies if it is true that it will exist anyway. So this extension will explain why you can effectively combat it. There are 2 reasons why. For one, why do people engage in crypto? People engage in crypto because they want to escape the middleman and so that they can engage in the private security mechanism of being in the ledger. What we do is that we offer the best of both worlds. So we're able to stabilize and prevent volatility, given the fact that you are putting an official trust in them, meaning that it's not based on some arbitrary ethereal number, which is what happens with Bitcoin or Ethereum. What happens is that it's grounded. So it's based on the government backing it, which prevents black swan events from creating volatilities whenever there's a shock. But second of all, we're able to escape environmental risks of crypto in terms of energy intensiveness, which is something that deputy leader of opposition wants to problematize. Because we're able to shift away to towards eco-friendly blockchain technology like proof of stake, which removes them of the environmental consequences and the energy intensiveness issues that opening opposition talks about. Sure, blockchain technology is energy intensive, but that's with Bitcoin, right? But if we see us moving towards other systems, we see other more benevolent cryptocurrencies being better. Obviously, the ones that governments will adopt are likely going to be benevolent. Given these two sets of reasons, they will transition to the better blockchain crypto currency model, which is why we combat it under our side. Flipping again the argument that opening opposition gives. Last extension, we limit poor macroeconomic monetary policy. The reasoning is simple. If it's true that what opening opposition says, where you can't control your monetary policy as much, this is better because we prevent ourselves from doing things like flooding the economy, leading to things like inflation, which is something that Jerome Powell has done. Why? Because blockchain technology significantly limits it because you're forced to mine it in terms of the currency, and there's a limit or a ceiling to how much currencies that are available in the market, which means that you stop them from doing irresponsible behavior that does things like increase inflation or, for instance, make it worse for employment. And for these reasons, we're proud to propose.
I'd like to thank the government member for that speech and call on the member of the opposition. Here.
Hi, hello. Yeah, just give me a moment to get a bit further. I'll start in 3, 2, 1. CO is going to win this debate on 2 levels. First thing is we're going to insist on multiple frames, regardless of not whether the blockchain is something that is located within that particular country or that particular state, or whether it is a global blockchain. The second thing is we're going to flip why extreme accessibility is terrible. We're going to take the best case of government and tell you why it is just the worst scenario ever, and then we're going to use this through historical analysis of how financial crises occur. Before that, 3 important points towards government that will take down government. The first thing that OG tells us is that it's easier for you to control fiscal policy. Pray no mind that this is about monetary, not fiscal policies, as what OG mischaracterizes. But we posit to you that's also illogical, because the central bank doesn't necessarily always deal with individuals directly. It is not always a matter of individual accessibility, but this is more about bank-to-bank transactions or assets or interest rates. But even if that were the case, we're going to discuss why we win that. But then thirdly, I think San properly takes down most of OG in the POI when she tells you that there is no point of change. Things like inflation targeting or yield targeting by the Reserve Bank of Australia is something that is done in status quo. If the control is a value that OG wants, we posit to you that the highest control is possible in status quo, wherein that you have the central bank that is not beholden to political incentives by like the rest of the state or by elections in the like, or just pure technocracy and pure what is the best for the economy. Posit to you that if control is the value, CO wins it. But then CG comes up here in this debate and tells you that control is not important. But we posit to you things like interest rates or yield targeting or the ability to control the yields on 10-year bonds by these central banks is the best way that we can deal with volatile markets when they come up. Because the central bank can't always crystal ball what will happen to the markets, and this is why it is important for them to have some level of control. The same way the U.S. Federal Reserve was able to slow down a lot of inflation within their own country when they were able to control interest rates. We think this is something that is extremely meaningful. The second thing is let's talk about accessibility and efficiency, right? Because they say this is something that they want to the greatest extent. The first thing we want to tell this is just generally untrue, right? Because the first in the short term, in terms of the short-term optics, like FTX people don't trust digital currencies in the first place. But then the second thing is just on the level of developing countries who cannot access this. But it's not just a surface level analysis of whether or not they have the ability to like have these machines at OO, but rather you also incur massive transaction costs in trading or liquidating the types of assets that you have when you have this in these digital bank currencies. In the same way that a free trade agreement creates trade diversion effects away from those who are not part of it. So it's not just micro level inaccessibility, but you shift investment and trade away from those who cannot to those who can. That is just an ultimately terrible world. But then the third thing is just we want to flip accessibility, right? So even if you get massive accessibility on government bench, why is it so bad? Things like hot money flows and the rapid ease of transactions is the very cause of many financial crises in the past. And here's the worst case that OO doesn't deal with. In the same way that the Asian financial crisis made the worst impacts on extremely connected markets like Thailand compared to the Philippines that was relatively insulated because its financial sector was not as widespread. So this means that it is on office government bench where they care about things like illicit activity, you're more likely to empower it because of just the scale of transactions that can occur, but as well as this just creates massive financial contagion. The last thing I just want to quickly respond to is just CG when they talk about predatory financial institutions. I think you just have to vibe check. I think when financial institutions are being predatory and have massive high transaction costs, I think it just take down or regulate the transaction costs. What we needed from CG was a comprehensive account of when exactly do we shift and change, uproot our currency completely. I don't think they're able to do this, but I don't think that their particular contributions have. So what exactly am I going to prove? Why it's a risky and disastrous decision on four different levels of analysis, and why is risk mitigation the most important value in this debate? But before that, a POI from OG. 3, 2.
Top lack comparative. We even took the harder burden than CG and said, even if banks aren't evil, here's why their transactions are still more expensive. Why is a poorer individual having access to a secure wallet, a mechanic in India being able to buy an additional day's worth of meals, less important than whatever benefits you're going to give us in terms of having like more isolationist trade and less like globalization leading to like, I guess, less crises or whatever?
The first response is that I don't think you sufficiently prove that the average person can access like these sorts of crypto or these sorts of digital currencies, especially when they're linked to the blockchain. Secondly, I think even if we don't take that, the idea of macroeconomic effects, the types of prices that you have all around the economy, whether or not you're able to put food on the table, the baskets of goods that you have is something that is far, far more important. So macroeconomics affects everyone on scale, and on that, I think we just win that particular clash. The first thing is on the blockchain storage. How is digital money like crypto and CBDC created? We think it looks like things like mining to gain credits, right? But also things like value on the value is based on the number of miners, and there's a finite number of credits available. Here's how we deal with the two frames of what happens in this debate. If it is just the central bank doing the mining with the localized blockchain, as what OG tells you, there's a massive, massive cost. Because you need a lot of blockchain miners by the state to pump out the usable currency. This is just massive opportunity cost in terms of state services. Second, if everyone is mining and it's connected to the global blockchain, I think that is where you're more likely to have the depressed currency value like the way that crypto was right now and not much purchasing power. It means that it's also more volatile to currency changes across the blockchain. No mind that your particular currency doesn't trade with that particular country, but because you're all interconnected in the global blockchain, a depression in one part in the other side of the world can affect you. It's just massively terrible. But the second thing is just terrible in terms of legitimizing cryptocurrency in general. Because the idea of this legitimizes or signaling effect to other individuals that cryptocurrency or other digital currency stored in the blockchain are a legitimate means. You worsen harms that I mentioned in the first layer, but also in terms of epistemic access and financial information. Happens because of the DR accessible information that happens when you implement this policy. So you're more likely to have things like crypto bros on social media who tell you to start investing in CBDCs and rehype crypto. If you're concerned about things like false advertising on CG, the problem with legitimization, it's a larger problem on their side when you have a blockchain that most people don't know how to use, and it's typically done anonymously. The third reason why it's just switch to a new system is just inherently destructive. You uproot old systems. So you think that's just massive cost, massive like epistemic access for people. But then lastly, it's just when I told you earlier, too much accessibility means rapid contagion in terms of financial failure. Why exactly is so debate winning? We tell you that risk mitigation is the most important value in this debate, and this is something that we're able to do. Things like the brittle and volatile economic conditions that we live in, the way the central banks affect debts and interest rates of the most financially vulnerable people, or the money or the purchasing power, whether or not they can put food on their table in their family. We think that government's messages are too much massive harms and giving you so many reasons why that's the case. And even on the benefits that they want, it's just a failure. For all these reasons,
I'd like to thank the member of opposition for that speech and call on the government whip. Hear, hear.
Hello. Can I check that I can be seen heard? Okay, cool. So, I prefer POIs to chat, please. If you'd like to raise POI, then please do so in chat. Thank you. Okay. All right. So I'll be starting this speech in 5, 4, 3, 2, and 1. We broadly agree with opposition. Individual control over your money and your financial decisions is incredibly important to every individual in the world. The problem in opposition, however, is your ability to personally have control over your finances is extremely destroyed when states make irresponsible financial monetary policies that end up requiring them to flood the economy with billions, if not trillions of dollars, accelerating inflation rates, and therefore reducing the value of your currency to nothing. It is destroyed when you are dependent on private financial institutions that we have explained have an incentive to be predatory in terms of getting innocent financial users of their systems to avail of loans that are not applicable to their context, to add unnecessary fees that you do not mind because they are so small, but are present in every single transaction you make, which make it such that even if only 1% of your wealth is being being used in every transaction, that is 1% that is being stolen unjustly from your pockets when it does not need to. Only our side is able to prevent these problems explicitly by explaining the mechanics of how the blockchain and how the CBDCs are exclusively able to prevent the harms of both irresponsible monetary policies from states, but also the predatory financial policies that private institutions like Alibaba or Gcash instill to make it such that a lot of the poor are often adversely affected. What I'll do in my speech is twofold. First, I want to broadly respond to opposition, and secondly, I'll rebuild the material and explain why it wins over OG. I first want to tackle the main claim from closing opposition. So the first thing I want to rebut extraneously before I integrate the rest of the responses is just to say that their response to our case is that state monetary policy is important. So we have to be able to give bonds to people so that we can fulfill the financial needs and demands of the state. The problem with this response is it is not exclusive in any way, shape, or form. I want to make it clear. The state still has some avenues of providing financial instruments to people in our world. We can still issue bonds if we need to. The difference in terms of state intervention into the economy that we explain to no response is the idea that in our world, states no longer have the capacity to print billions of additional dollars to flood the economy and compensate for rising inflation costs. Now, because they have to work within the limits of a blockchain, there is a fixed rate at which you can produce more money and circulate that money into the economy. So states cannot artificially accelerate inflation, and you're therefore able to prevent that harm. But secondly, it also encourages states to be more responsible with their financial decisions in the first place. The reason why countries like the US feel emboldened to make irresponsible financial decisions is because they know they can get away with it, relatively speaking, given the relative strength of their currency. If they know that they cannot have access to printing infinite amounts of money as a solution, then they are going to not make decisions that would threaten the entire value of their currency in the first place. And therefore, I think that's intrinsically valuable as a response. Before I continue, sure, opening up, you want to run POI?
This currency is still state-controlled and vulnerable to poor monetary policy, but it is very easy to break into the digital payments market. Look at Wise's rise against PayPal recently. Why is this competition not enough to reduce transaction costs, and CG feels like it has to occur, the huge risk that opening opposition explains?
That is a very wonderful transition to the next part of my speech. Before I deal with that specific issue, I have a few extraneous responses that I want to give to opening opposition first before we deal with that. So the thing I want to respond to opening opposition extraneously is this idea on privacy that they push, particularly at Deputy, and where they say that privacy is important and privacy is jeopardized because states now have exponential access to your information, which they shouldn't have in the first place. I have two responses to this. Number one is opening opposition does not explain why privacy is an a priori value. I want to flag that states already track and have access to most personal information of citizens in the first place. By virtue of your birth certificate, they know where you live, where you work, who your family is, what your tax returns are. They can also track your financial transactions. A lot of companies that when you buy something from a company, they store the receipt. So companies also have access to this information. So it's not clear why privacy is intrinsically so important if their world also has many violations of privacy from the state. But number two, they also assume that privacy is violated. So I want to make this clear. When you are looking at accounts on a blockchain, you cannot see people's personal information. You can't see their name, their family, their relatives. You only see an account number, just as you would with any other bank account. Even if states have access to this information and they can track which accounts belong to which people, it doesn't have any tangible effect on everyday people in their day-to-day lives. People do not think about the fact that states have access to this information because states typically don't do anything about it. If there is a gross violation of privacy to the point that citizens feel incredibly unsafe, then there will be political mobilizations to prevent the state from acting in that manner. But insofar as states don't do anything with that information, which they have incentives to not do because it's unpopular politically, then nothing bad will happen on opposition. So I just don't think privacy is that important in this round. Lastly, what exactly is the extension that we explain? Why private institutions are much worse than central bank regulations that was not responded to from opposition. We explain two different things, two different mechanisms which make private digitalization of currencies exponentially worse than state-controlled CBDCs in our case. Number one is we explain that there is a lot of predatory financial intermediaries that exist. Again, because this system is likely to manifest in an oligopoly where only a few companies, if not one company like Gcash or Alibaba have access to all of the digital wallets of an entire country. Number one, they just have fiat to be able to set high transaction fees because they have market capture. Like 90% of China uses Alipay, so Alipay can literally set whatever prices they want for transaction fees. But number two, even if there are incentives for this to be lower on opposition, that it doesn't change the fact that these transaction fees are placed on every transaction you make. And note, people make thousands of transactions every single year. So cumulatively, it adds up to a lot of money being taken away from you in converse. Only RSAD is able to prevent that because the validation fees of states are non-existent compared to transaction fees, which are certain and guaranteed. For those reasons, we're proud to propose. Thank you.